So one of my favorite ways to invest in the stock market is with dividend investing. Dividend stocks are awesome because I think they give you the best of both worlds. If you get into dividend investing and get the right companies, you can actually pick stocks that are going to grow and have great growth, as well as paying you on a quarterly and sometimes monthly basis. And in this video, we're going to get into the real estate sector. Stay tuned to the end so that you can see which ones that I kept, which ones that I bought, and which ones I sold. Welcome to the channel. My name is Paris Clough, and this is Financial Self-Reliance. I absolutely love helping people manage, protect, and grow their money. In fact, one of the most fun ways to grow your money is with dividend stocks. It creates for you an opportunity to get into the stock market, to learn the ins and outs, to have some growth potential there with the different stocks and companies that you choose, but it also gives you the opportunity to have what is that famous and absolutely wonderful passive income. Literally owning shares of the companies I'm going to share with you today is going to pay you on a monthly basis and on a quarterly basis every single year, every single quarter, every single month. And if you pick the right stocks that are going to stick around and are going to be there for the long term, you can have that income long into the future. So dividend stocks are super awesome. There's 11 sectors in the market, and this video is going to talk strictly about my consolidation in the real estate sector. One of the things I like about the real estate sector is there's a high level of monthly payers. What that means is every month you can have an income coming in from some of the stocks and some of the positions I'm going to share with you today. And so let's jump right into my spreadsheet. Now, my spreadsheet is one that I've created. I created this when I first started my journey. My brother and I were out there on YouTube, and we saw some people creating spreadsheets, and we kind of consolidated a few things that we really liked into one spreadsheet, and this is the one that we created. So as you can see over here on the right-hand side, we're in the sector real estate, and over on the left-hand side are the different positions that I've had. And so I had GNL, GOOD, IRM, LTC, MPW, O, which is super famous, and most people know about that one, OHI, and STAG. And we're going to talk a little bit about STORE at the end as well. So this is the spreadsheet that I keep track of, where every time I make a change or do anything, I definitely put it on this spreadsheet. But then I also go over to the dividend tracker, and the dividend tracker keeps track of things for me as well. It's a fantastic program. There's a link in the description below for you to check it out. Now, everything that I do when it comes to individual stocks and dividend stocks, I do it on Webull. Webull right now has a promotion going on. If you click the link in the description below, open up an account, you can actually get some free stocks. What better way to start your investment journey, or even to continue your investment journey, than with free stocks? To me, free is my favorite four-letter F word, so I went for it. Anyways, let's talk a little bit about that first position that I had and have in my portfolio, which is Global Net Lease. GNL got a 24, according to Dividend Tracker. They got a 24 out of 100 dividend grade, which isn't that great. And so one of the reasons why I chose GNL in the first place was over here on Seeking Alpha, we'll see, is because of their dividend yield. 10.6% dividend yield. That's a fantastic yield. Although what I've realized after chasing the yield for a long time is that some of the companies that I chose in the beginning of my dividend journey, some of them have gone out of business, some of them have been merged into other companies, and several of them have lowered their dividend or completely wiped their dividend out altogether. And so I had to sell off so that I could buy stocks that would continue to pay dividends. And so I started to think that I should probably get a little bit better research into these companies. And so I went here and I looked as an example, the dividend grades here. This is a dividend scorecard on Seeking Alpha, which is a very popular and very well-respected site for research. And so they have a D- as dividend safety, D- dividend growth, A+ in the yield, of course, 10.6%, and then dividend consistency, D+. So I realized that I should probably sell GNL because the rest of the statistics don't look that well. A+, if you have 3 Ds and an A, it's not that great of a GPA, if you know what I mean. So I sold them and used that money to be able to buy some other positions I'm going to talk about in a minute. The next position that I had in my portfolio was GOOD, or Gladstone Commercial. And they, again, 23 out of 100 dividend grade. Over here on Seeking Alpha, the dividend scorecard brings them in as a D-, a D, an A, and a B on consistency. 7% dividend yield, so fantastic yield. A 5,000% payout ratio. 0.05, I mean, that's really not even anything, 5-year growth rate. 3 years of dividend growth is okay, but the scorecard is not that fantastic. So I went ahead and sold my Gladstone, or my GOOD. I sold my GOOD stock. It's kind of funny. The next one here in my position, my portfolio, is IRM, Iron Mountain. They again have a 23 out of 100. Not that fantastic of a grade there. Looking at the dividends here, they've been paying 12 years of dividends, which is good, but they have had 0 years of increase in their dividends. Their scorecard shows them as an F, dividend safety, C+, dividend growth, B+ is dividend yield, dividend consistency is a D. And that's kind of things you want to have. You want to have safe, dividend growth and yield are nice. But safety and consistency are also just as critical. And when you have an F and a D in those categories, to me, it was time to sell. In fact, if you look at the summary here in Iron Mountain, warning, IRM is at high risk of performing badly. When you log in and you see a sell rating over here and a warning label here, it's time to probably consider getting rid of that stock out of your portfolio and exchanging it for something that's a little more, has a little better grade. So I did that. And so the next one I have the next one I had, it was called LTC Properties Inc. And that's again a 22 dividend grade. I'm showing how much I actually bought on yield. I bought these positions on yield because their yield was fantastic. Who doesn't want a 5.7% yield? But when you have a dividend safety of a D, dividend growth of a D, it's not the kind of dividend portfolio that I want to have anymore. I want to have a good strong yield, of course, but I don't want to have a dividends that are going to go out, the companies that are going to go under, the companies that are going to cancel their dividends, lower their dividends. I want to have good, solid, strong companies where I can really do get the best of both worlds, where I do get that growth as they continue to grow and stay in business, but also to have the growth in my dividends and have that dividend increases. And so this one has a 5.7 yield, payout ratio is 160%. Not a very good 5-year CAGR. Dividend growth is 0. So I went ahead and sold my LTC properties. Now, MPW is the next one that I had on my list. MPW is actually a 61 out of 100, which is a much better dividend grade than the ones we've been looking at so far. Let's see over here on Seeking Alpha, the dividend scorecard shows a B minus dividend safety. That's good. Dividend growth is a C plus, dividend yield is an A, and dividend consistency is an A. That's the kind of grades that I want to have. And so if you look here at the dividend history, you'll see that they've been paying for 16 years. They've been increasing for 9 years. That's what that means up here. So if you go back to the scorecard here, we can see that they have a 6.73 yield. So here's the thing, is that I was seeking for yield, but I was picking companies that didn't necessarily give me that strong, solid other side of it. So this company, MPW, has B minus and A in the right places, and it has a fantastic yield of 6.73%. So I decided to keep my positions in MPW. Plus, look at the price there, $17.20. That's a very low price. You can get in on that pretty quickly and easily. Probably pick up several shares for that low of a price and be off to the races with some MPW in your portfolio. All right, here we go. The one that's kind of the famous one that everybody knows about. Realty Income. This is one of those famous monthly payers. This is one that everybody that I've ever heard about in the dividend world that really knows anything about dividends either has this, or it's in their portfolio, or it's on their watch list, because Realty Income is actually an aristocrat. Let's take a look here in a minute. It's a dividend aristocrat. So they've been paying consecutive years of dividend payments, 28 consecutive years. And for 25 of those years, they've been increasing their dividend. So increasing your dividend for 25 straight years is a pretty strong indicator that you're going to keep doing it. You're a good, strong business. And interestingly enough, even with that record, they still have a C in safety, a C plus in growth, a C in yield, but an A plus in consistency. So they're committed to making sure that those dividends come back every year and come out as often as every month. Actually, these guys pay every month. So 4% yield on that, which is a fantastic yield. 25 cents per share is what they're giving out. Monthly payer, fantastic company, Realty Income. In fact, Quant Ratings have it as a strong buy, and that rating there is a 4.7 out of 5. So that's a really good indicator that Realty Income is going the right direction. Again, this is going to be one of those ones that's going to give you the growth and the income that you want. So I'm going to be building my position in Realty Income and getting some more of that. So the next position that I had in my portfolio was Omega Healthcare Investors, OHI, and they're at 25 out of 100. Seeking Alpha has them as a D, D plus, A plus, and C minus. So again, they have a great yield, 8.65%, but they have Ds and the other important things that you want to look at. So Quant has them as a hold rating, 3.33 out of 5. I personally, with 0 growth years, 1.73 growth rate, 143% payout ratio, I sold OHI. I figured that I was going to be able to use that money in a better place. The next position that I had, actually the last position that I had, was Stag Industrial, STAG. And they are 53 out of 100, which is a much better grade than some of the ones we've been talking about. And over here on Seeking Alpha, their dividend scorecard has them as a B, a D plus, a B minus, and an A minus. So they have a 4.4 dividend yield, 113% payout ratio, less than 1% 5-year growth rate though. But they have been increasing their dividends every year for the last 7 years. So Stag is a good company to have on your watch list. I'm going to keep it on my watch list anyways. I sold it so that I could actually buy the next one. This is one that I didn't have on my dividend portfolio, but I wanted in my portfolio. And that's STOR, ticker symbol STOR. And they have a dividend grade of 60 out of 100. And over here on Seeking Alpha, they have a B minus, B minus, B plus, B plus. So they have much better score. They have the same growth rate as Stag, but the rest of the grades, in my opinion, are much better. And Seeking Alpha has the quant rating here as a strong buy, 4.64 out of 5. So my opinion is that obviously my opinion is that I sold my Stag to buy some STOR. And one of the other cool things, one of the reasons why I found out about STOR in the first place is because I was reviewing Warren Buffett's portfolio, and he has STOR in his portfolio. So I figure if it's good enough for Warren Buffett, it's good enough for me, and so I'll keep it as well. But Seeking Alpha does have it with a really good scorecard. And so let's talk a little bit about the real estate sector. I did a stock screener, the top 7 stocks in my search results and the criteria that I put through. O and STOR came in as on the top 5, and so I was excited to be able to have 2 of the top 5 in my portfolio. And now, anyways, I had 1 of the 5 before, now I have 2 of the 5 in my portfolio. So I took most of that money, and as I shared with you in my last video, I took most of the money. I did buy some Realty Income. I did go from 5 to 10 shares in that, and I did buy 10 shares of STOR. However, I took the rest of the money and I bought into a fund that's or a position that's going to allow me to do covered calls on a weekly basis and earn a little bit more premium. So I'll share with you a little bit more about which stock I did in a future video when I talk about my covered call strategy and how I'm making money and increasing my premiums and increasing my cash flow using covered calls. Before I let you go, please check out my Facebook account. Go to Financial Self-Reliance. This is my Facebook page. If you go to More and click on Groups, it'll take you to the Manage, Protect, and Grow Your Money Personal Finance and Investing group. I'd love to chat with you there. And then maybe we can have some question and answers and really get some good community building going on over there. So really appreciate you taking the time to watch the video. If you made it this far, I'm so grateful. If you missed the last video I produced, you can find it here. Go ahead and subscribe to the channel up here. And if you want to watch a video that YouTube thinks you might like, go ahead and check this one out up here. Until the next one, have a fantastic day.